January 1, 2004. The Real Estate Capital Scoreboard. January 2004. Last year finished as one of the most attractive financing environments in over 40 years. The Fed maintained rates in check with long-term benchmarks, fluctuating as much as 125 basis points. By year-end, rates inched up and stayed steady throughout the fourth quarter. And while rates moved up slightly, lenders tightened overall spreads in an effort to generate greater funding volume. Beyond any doubt, the real estate capital supply equilibrium favors borrowers, as more money is available versus funding opportunities. Although the economy is recovering, policymakers exercise caution as far as interest rate adjustments. Many believe that 2004 will be a relatively steady year without any major rate increases over the immediate horizon. LIBOR pricing is slightly lower than a month ago, dropping about another 5 basis points. Floating rate loans still offer the best option for rate-conscious borrowers willing to assume more fluctuation risk. February 1, 2004. The Real Estate Capital Scoreboard. February 2004. As 2004 funding goals are established, most capital sources expect extremely competitive bidding on all funding structures ranging from joint ventures to construction loans. Lenders provide a variety of creative solutions for offering competitive financing terms over and above pricing. Examples include aggressive mezzanine and secondary financing programs, capped legal fees and closing costs. At the risk of being repetitive, loan pricing is at historically low levels. Spreads continue narrowing across all property categories and spectrums. Lenders are willing to accept lower capitalization rates since about a year of trailing sales data establishes new valuation benchmarks. The Fed decided to leave rates unchanged last month, what expressed willingness to raise rates later in the year.
March 1, 2004. The Real Estate Capital Scoreboard. March 2004. 4% represents short-term fixed-rate debt, with 10-year mortgages priced about 100 basis points higher at 5%. These rates are among the lowest in modern history, translating to spreads of 100 basis points to 150 basis points over comparable term treasuries. Without a doubt, any type of permanent financing, whether fixed or floating rate, is extremely attractive. Of course, such low wage are translating to equally low capitalization rates, dipping well below 8% for most income properties and in the 6% range for prime multifamily assets. The likely trend remains for tightening spreads and even lower interest rates and more attractive leverage. A great time to be a borrower. The Real Estate Capital Scoreboard. April 1, 2004. March was a relatively calm month for interest rates. Short-term rates were virtually unchanged. Treasuries closed about 20 basis points lower than February, fluctuating no more than 30 basis points within this time frame. Overall interest rate movement during the past 6 months continues trending downward, with the rates settling about a half a point higher as compared to the 40-year low levels of last spring. Although absolute treasuries rates are a half point higher than last year, mortgage spreads over treasuries are much more favorable than any time in recent history. Many conventional mortgage loan programs with full leverage are quoted at spreads within the 100 to 130 basis point range. The end result: long-term mortgage rates priced below 5%. May 1, 2004 The Real Estate Capital Scoreboard May 2004. Not since last summer have rates climbed so rapidly within such a short time frame. During April, medium and short-term rates spiked by nearly a full percent. Rapidly rising energy costs along with a positive economic outlook ignited treasuries. Today's rates are about the same as the summer of 2002. All short-term rates remained unchanged, however. That said, rates start at 4.5% for shorter maturities and 100 basis points higher for longer maturities. While treasuries are climbing, overall mortgage spreads remain steady. However, numerous lenders are discussing raising rates as fears of inflation are more pronounced. The overall rate trend is moving away from the 5% range. With recent rate spikes, buyers are negotiating lower purchase prices, yet no hard evidence exists for higher capitalization rates. A 2 to 3 month lag is expected for equity market pricing to readjust as investors need clear signals as to capital market behavior.
June 1, 2004 The Real Estate Capital Scoreboard June 2004. May's interest rates fluctuated by about 50 basis points during the early part of the month and remained relatively steady thereafter. The overall trend indicates longer-term rates are slowly rising. As is the case throughout this year, short-term rates remain unchanged. Equity pricing starts at 6% or more for multifamily capitalization rates. Other conventional income property assets are trading slightly below 8%. With pricing pressures favoring sellers. Overall yields dip below double digits figures for the highest quality assets. July 1, 2004 The Real Estate Capital Scoreboard July 2004. A mid-year real estate capital market summary indicates that overall interest rates are priced in the 100 to 150 basis point range for most permanent loan opportunities. These spreads translate to overall rates of about 4.75% for 5-year term loans and about 100 basis points higher for 10-year maturities. Floating rate loans are priced within the 4% or lower range with prime borrowers, however below 5% is relatively standard. Regardless of posted rates and to mitigate any pricing premiums, lenders provide floors, but are willing to exercise more flexibility relating to leverage, property type and other underwriting variables. As is the case for much of this year, pricing is at historically low levels without any fears of substantial increases in the near term.
August 1, 2004 The Real Estate Capital Scoreboard August 2004. Medium and longer-term rates held steady since the Fed's rate increase of June. 5 and 10-year treasuries traded within about 15 basis points and closed at nearly the same levels as a month ago. In fact, rates are nearly identical to a year ago. Short-term rates increased by about 15 basis points, after remaining steady for most of the year. 30-day LIBOR still hovers at extremely low levels of about 1.5%. Higher leverage and smaller loans are priced about 25 to 50 basis points higher than the typical range of 100 to 150 basis points for standard loans. Despite increased interest rates, capitalization rates and mortgage spreads are relatively stable.
September 1, 2009. The Real Estate Capital Scoreboard. September 2009. Chicago, Illinois, September 1, 2009. Declining property values. Prices reset investment yield boundaries for all types of income-producing properties. No asset classes are immune, ranging the entire spectrum from institutional quality, credit net lease deals to distress hotel ventures. With limited exceptions, new construction developments grind to a halt as investors rethink risk/reward because of ever-eroding market fundamentals. The DeFi takes front stage among lenders with legacy loans, whereby debt terms are defensively renegotiated. All parties try to avoid foreclosures as long as the collateral is reasonably maintained at occupancy levels within the given submarket. DeFi loan sizing is further outlined as follows. Other than senior housing in select markets, few properties see any rental growth. Protecting existing cash flow remains a top priority in contrast to any increases. Pro forma projections are reviewed downward, as owners expect stable or declining rents/occupancies. For instance, multifamily properties with rental decreases of 3% or more are underwritten and trended downward versus trailing operating history figures. Markets are strained with a special emphasis providing some form of debt relief in key markets, for example, Florida, the Inland Empire, Phoenix, Austin, Las Vegas, Atlanta, the Upper Midwest. Voluntary conversion of debt to partial equity is offered as an additional solution to eroding debt balances, increasing 2% or more on vacancy rates for apartments. Roll-in of the prepayment penalty deemed to be a cash-out, defined as an optional cost to better their financing, hardlined by FNMA-small penalty, for example, 2%, not a big issue if a couple of 2% on LTV but not 75% to 80% jump, for instance. Standard provisions include lengthening amortization schedules and loan term, offering interest-only payments, reducing, or removing, non-monetary default provisions such as debt service coverage and loan-to-value covenants and partial forgiveness of debt. The Real Estate Capital Institute's advisory board member, Harold Skip Harry, laments, "The volume of foreclosures and restructuring leads me to believe the end is not in sight for at least 1 to perhaps 2 years." Skip suggests, defensive investment tactics are the norm rather than the exception until more trades occur and properties are marked to market based on current conditions.
October 1, 2004. The Real Estate Capital Scoreboard. October 2004. Mortgage interest rates and underwriting dynamics remain relatively unchanged as compared to the previous months. Overall interest rates and spreads for longer-term debt approximate market conditions as of the beginning of the year, as treasuries have slowly moved downward during the past 2 quarters. Capitalization rates continue dropping to record low levels as buyers and sellers agree that low interest rates are here to stay. Pricing pressure is particularly evident for a long-term, net leased, 1,031 exchange transactions. Yield curves are narrowing for various debt instruments, indicating that the market is returning to normal levels. For example, The difference in yield between 2 and 10-year note is the slimmest since 2001, nearly 85 basis points lower than the beginning of the year. The rate compression indicates that investors expect policymakers to control inflation. However, LIBOR, bank prime and other short-term rates remain on a watch list, as the Fed raised its benchmark interest rate for the third time this year. November 1, 2004. The Real Estate Capital Scoreboard - November, 2004. Even though rates increased steadily over the past months, by historical standards mortgage pricing remains unbelievably favorable as spreads over treasuries are unusually low. Realty capital markets are at extreme levels of overcapacity. Despite marginal fundamentals, investors reluctantly pay record prices for nearly all classes of properties, particularly core and value-add assets. Hotels are returning to favor, while investors shun commodity office properties. Premium prices have not deterred capital flow into commercial real estate as stocks and bonds remain relatively staid. To capture yields above the single-digit range, more investors are exploring mezzanine and opportunity plays. All in all, borrowers reap many financing options matching various risk profiles. Short-term rates continue upward movement at a measured pace as a result of the Fed's fourth rate increase this year. Only about 1.5% difference exists between 30-day LIBOR and 5-year treasuries. In contrast, the spread difference was nearly twice as much a half a year ago, indicating that investors are seeing more normal yield curves.
December 1, 2004. The Real Estate Capital Scoreboard - December, 2004. As expected, longer-term interest rates and mortgage spreads remain mostly unchanged, flirting with the lowest levels in modern history. The 5-year Treasury bounced as much as 50 basis points, settling about 25 basis points higher by the middle of December. The 10-year Treasury performed steadily, barely increasing 10 basis points during the same timeframe. LIBOR climbed 40 basis points this past month, resulting in more borrowers exploring medium-term, fixed-rate options as the difference on pricing models narrows. Mortgage spreads are tightening for entrepreneurial properties including hotel and other non-conventional assets as funds remain abundant. In some cases, mortgage spreads for hotel properties have dropped in excess of 50 basis points this year.